Broadcast is now starting. All attendees are in listen-only mode.
Interruptions here and there.
All right, so good evening, everybody. Welcome to Bursa webinar number 10, Uncover the Myth of Oil and Gas Industry. Now, as usual, before we begin, just want to check if you can hear us. If you can hear us, can you please go to the control panel and click raise the hand button. If you can hear me and you can see my screen, please go to click raise the hand button. Okay, thank you very much. You may put down your hands now. You may put down your hands now. Okay, excellent. Thank you so much for coming. My name is Shane. I'm the moderator for this webinar. Now, we are doing this live, but for a smooth delivery, we would want to save the bandwidth by turning off the webcam for the entire period. Now, we have an amazing turnout today, and we feel very encouraged. And our topic today is very unique. It is about the oil and gas industry. As you know, oil and gas industry is one of the sector that contribute the most number of percentage of GDP to our country and to our government. So it's really important for us, for you to know what is this industry doing. So this webinar is about 90 minutes long with 60-minute content and 30 minutes Q&A. But of course, the timing is tentative because sometimes we may have overwhelming questions that we will spend more time to answer the questions. So disclaimer. Now, the information that we share in this webinar is only for educational purpose only. So the case studies or companies that they dissect is also for case studies only. In no way that Bursa Malaysia or us give any buy or sell signals or buy or sell call to any of the companies. If you decide to buy any of these companies or sell any of these companies based on our discussion today, you do it at your own risk. Is that okay? Now, excellent. So we have a series of webinars that have in line for you today. Today's webinar is the last for the year of 2017. All right, so this is about oil and gas industry, but we are now planning for the new series for 2018, so stay tuned. So this series of webinar is brought to you by Bursa Malaysia and managed by us, LifeChamp. So allow me to introduce our speaker today. If you have followed through our previous webinars, our speaker is no stranger to you. He is a author of Invest in REITs, which reads popular top 10 fiction non-fiction bestseller. He's a full-time investor, author, trainer, and have been investing in Bursa International market since 1995. With that, without further ado, let me pass it to you, PC. Let me make you a panelist. Let me make you a presenter first. Okay. All right, here you go, PC.
Hi, good evening, everyone, for tuning in. So, thank you, Shane, and a very good evening to all of you. Now, today we talk about uncovering the myth of oil and gas industry, and one of the first on the topic will be explore the oil and gas industry, understand the upstream, midstream, and downstream operation and difference. Understand the difference between those directly involved in exploration and production, the E&P, versus those involved in the services. And also we'll have a look at renewable energy and the future of oil and gas industry and paradigm shift from combustion engine vehicles to electric vehicles. Now, the oil and gas industry in Malaysia, it is an important contributor to the Malaysian GDP. In 2016, it accounts for 14.5% of the country's gross domestic product (GDP) and 14.7% to the government's revenue. This is from the Star article published on 24th of May 2017. Now, prior to the fall in the oil price in 2014, the oil and gas sector actually contributed even a larger portion of the country's GDP, hovering around 20 to 30% during those periods. So you can see that it has fallen down quite a lot because of the downturn in the price of oil. And according to a PwC, PricewaterhouseCoopers report, there are more than 4,000 companies involved in the oil and gas industry. So talk about the oil and gas industry. There are different differences between oil and gas. Okay, then we look at the oil and gas industry, which consists of the exploration and production, and this within the oil and gas industry, which can be classified as upstream, which is primarily in the exploration and production, midstream, transportation and pipeline, downstream, refining and end product to consumer. Now, whereas the E&P stands by itself, services could cover activities in upstream, midstream, and downstream. As we go along, we will explore each individually. Now, we talk a lot about the oil and gas, but what's the difference? Now, oil is a mixture of hydrocarbon, which are liquid at room temperature, while gas is a mixture of gas formed from fossil remains buried deep inside the earth. So normally the gas, due to the intense pressure of the earth, they would seep through the crevices in the rock structure and reach a certain areas where it can be drilled and then pump out from the rock structure. Yeah. So oil, it is widely traded as a commodity in US dollars per barrel. Yeah. Production is measured in barrels of oil per day, and sometimes it's quoted in the following. There are a few types of short forms that is used, and don't be confused, it all means the same thing, such as BBL stroke D, which is barrel per day, BOPD, which is a barrel of oil per day, BOE, barrel of oil equivalent per day, which means it's still within a barrel, okay, or just B stroke D, which is a barrel per day. Yeah, there are three oil benchmark, which is the WTI, West Texas Intermediate Crude, Brent Crude, and the Dubai Crude. And benchmarks are used to distinguish the many varieties of grade in the crude oil. Yeah, but most commonly used are the WTI crude and Brent crude. The Brent crude is less light and sweet compared to the WTI crude and contains higher levels of sulfur. Okay, that's the main difference between the Brent and WTI. Light crude is used to blend with heavy crude in the refining process. Now, if let's say a producer only produce heavy crude, heavy crude itself cannot be refined. Okay, so it needs to be mixed with light crude and then refined. Now that is why Venezuela is facing a lot of problems, because they have a lot of oil reserve. Okay, but then theirs is a heavy crude, and heavy crude, you need constant maintenance, and because the country is rather bankrupt, their oil production also dropped drastically, and the quality of the heavy crude also starts to drop, which makes the oil even less marketable and making Venezuela even worse off in situation. So normally the heavy crude is mixed with light crude. There's a API gravity test to determine whether it is light or heavy, and anything that has a API gravity of more than 10 is considered light crude oil, whereas API gravity of less than 10 is heavy crude oil. API is the American Petroleum Institute, and this is the gauge that they use commonly. Oil usage. Almost 2/3 of the world's crude oil is refined for transportation use, which is for petrol, jet fuel, and diesel. And other uses include liquefied gas, petrochemical related industries, and asphalt. Asphalt are normally at the most bottom layer of the refinery tower, when this is mixed together with pebbles, and then it becomes the bitumen that is put onto the road. Oil production and price. Now, this is a source from ycharts.com. Okay, the oil production is currently, according to the Y chart, is 81.25 million barrels, but then per day, yeah. But then it looks to be slightly more on the upside right now. Okay, and you can see that as the price of oil starts trending down, okay, the barrels of oil produced per day actually was trending up. So you can see that because of oil production is increasing, causing an oversupply of oil in the market, and therefore the price of oil starts to trend down. And in fact, the production continued to move up until in the early part of 2016, where crude oil actually fell, okay, to more than $20 per barrel from a top of $100 per barrel. So you can see that it is inverse of the other, okay. But you can see that currently, yeah. So very importantly, the price of oil is very determined by the production, okay. And if let's say production continues to grow, then that will impact the price of oil. Recently, the price of oil has been trending up. I think in the past few months, it has moved up to the above $50 per barrel on the WTI benchmark, mainly because of renewal of geopolitical concerns, okay, in the Middle East, and also the OPEC countries, together with Russia, have been working at cutting production. So what drives the oil price? What is positive for oil would be rise in global demand, disruptions to supply, okay, and especially for those major oil producers, yeah. If let's say there's disruption due to pipeline leakage, or there's a hurricane season in the US, which impact upon the offshore oil rigs, yeah, which are producing oil in the Gulf of Mexico, okay, and cause a massive shutdown. That could also push up the price of oil, because suddenly there's a production is shutting down across the Gulf region, okay. So or previously, what happened in Nigeria was a disruption caused by the war between the government and also the Boko Haram terrorists, okay, which disrupted the pipeline. So then again, oil also spiked. So oil is very sensitive to any disruptions to supply, and especially when there are geopolitical tension in producing regions, yeah, especially more so in the Middle East. Now the Middle East is forever tinderbox, yeah, for certain major crisis, okay, because of the volatile political situation there, yeah. Especially right now, you have Saudi Arabia having internal strife, because the Crown Prince Mohammed bin Salman, okay, is targeting other princes, okay, on their financing, and also Saudi Arabia is waging a war in Yemen. So all these are causing a lot of tension in the area, especially in Yemen, where on one side you have Saudi Arabia backing one faction, and then you have Iran backing another. Okay, and recently there's been missiles being fired across the Yemen into Saudi Arabia. So these are the kind of situation which could actually deteriorate much further. And then we have also Israel making flight incursion into Syria and bombing some targets there. Okay, another thing that
PC. I can't hear you already, PC. Are you still on the line? All right, I think the presenter is now offline, because I think he has some internet disruption. So let's wait for him to come online. In the meantime, you can write down any question that you have in the chat box and in the question box, and we would address it in a short while. Okay, just maybe give him 1 to 2 minutes. PC, are you back on? PC, are you back on? I think I'm seeing PC online now.
Yeah. So
Oh, so you're back.
what is negative for oil? Yeah, would be a recession. Okay, because any recession would actually cause economic activity across the globe, okay, to fall, and therefore demand for oil would actually reduce, and the overproduction resulting in supply being more than demand. Now, this is very true for the U.S. shale oil, where the shale oil is actually a rather loss-making venture, put it that way, because shale oil actually have a initial production rate of maybe 5,000, 6,000 barrels, but within the first year it would readily deplete by about 50%. So then the second year, out of that 50%, it will deplete by another 30%. So because it is depletion in production, they need to constantly drill to ensure that the production meets demand. So that's when they borrow a lot of money to keep on drilling. Okay, in fact, a lot of the shale oil producers in the US, they are cash flow negative, yeah, and their debt level is extremely high. But that's what they need to do. They need to constantly produce just to boost up their share price. So that's why that is causing a huge oversupply, which caused the oil price to fall rather drastically in 2014. And between 2015 and 2016, what we have is that because of the price of oil falling from $100 over per barrel to about 60s and 50s, we have the Middle East country increasing their production even greater, so as to meet the shortfall in their budget and to reduce the deficit. So then they produce even more, okay, causing the more oil, more barrels of oil per day being produced and going into the market, and therefore it caused oil price to fall even steeper, down to 20 plus US dollar per barrel for the WTI. So because of that, since then they actually have been meeting and cutting production, yeah, and a lot of the US shale oil producer, because of their limited ability to drill further because of their excessive debt, okay, they also reduce. But when oil price spike up to the 50s, then we see again the US shale oil, started to increase production back again. So that's why I think that oil is unlikely to move way back to the $100 per barrel because of all these dynamics that is happening in the global market. And it can only go up to $100 per barrel when there is a major crisis, okay, in one of the maybe in Middle East, maybe a war, okay, or there's an economic crisis that caused all the central banks once again to print even more money, okay, and then US have QE and all those that caused the US dollar to fall further, and that would push up the price of oil. So that's why a strong US dollar would also be negative for oil because it is trade in US dollar. So the stronger it is, it is the reverse of the weak US dollar, where the price of commodity would go up, and a stronger US dollar would result in a lower price of commodity. Okay, and then there's also the threat of shift to renewable energy. There's been a lot of development in the renewable energy space, and it will actually cut into the demand for oil in the near future. So gas used for heating, cooking, electricity generation, and fuel for vehicles. Price is measured in US dollars per MMBTU, which is US dollar per million British thermal unit. Yeah. So gas price follows closely with that of oil, but it will be more volatile during the winter months. So you can see that during this period, especially 2016, beginning of 2016, you see the spike here because this is during the winter. Okay, beginning of 2014, where they have there's this spike going into the winter, but then 2014 has a prolonged winter. Winter was for a longer period, and then it spiked up the price of gas as well. Then you see at the beginning of 2017, in this period, overlapping December and January, there's also another spike because of the use of gas for heating oil during for heating purposes during the winter months. So exploration and production. Exploration and production is an upstream activity. It is an expensive venture, high risk and high reward. Exploration cost depends on the geographical location and geology of the rock structure. It would require the necessary geological survey data, financing to procure the land or block of block. Normally they use it for offshore, yeah, where they have a certain block of areas, okay, to be used for offshore drilling, and all the equipment necessary to complete the drill. If a drill is successful, then the next stage is to determine the commercial viability before production begins. The cost of an oil well from exploration to production, okay, for offshore, it can cost between $200 million US to $650 million per well, depending on the depth. Okay, so you can imagine if a company is to invest in drilling on an offshore platform, yeah, and it's very, very deep, you know, then it's like burning in Malaysia ringgit terms, it will be definitely more than you know, close to about 2 billion ringgit. So if they don't discover any oil, then the whole 2 billion ringgit is burnt. So that's why normally offshore exploration are undertaken by huge petrol companies, okay, or it could be a certain block and it's co-owned, okay, it's a JV between multiple small companies, okay, which then each company putting up several tens of millions, okay, to initiate the joint venture to drill for oil. And onshore oil well can cost between US 1 million to US 50 million per well, depending on the depth. Now, if let's say you are doing a vertical drill, which means it's a straight pipe down, okay, to the rock formation, and where they discover oil, then that could be very, very cheap. But if let's say it's an onshore oil well with horizontal drilling, okay, then it becomes more expensive, because once they drill to a certain level, they have to move that drill bit horizontally. And if let's say that horizontal drill covers, sometimes a horizontal drill can cover several kilometers long, yeah, and that is when the cost will actually escalate. Now, if you include fracking, fracking is actually called hydraulic fracturing, which after they drill across horizontally across an oil strata, oil-bearing rocks, okay, but the oil cannot flow by itself. So what they do, they input chemical, sand and water, and then they have minor explosion, okay, that penetrate into the rock surface, and that chemical with water and sand will actually break the rocks and allowing the oil to flow freely. So that's called fracking, yeah, and it's more expensive, of course. So let's look at the exploration and production process. Procurement of geological survey data is the most important step, okay, to know. Normally you wouldn't find, okay, companies wouldn't just spend millions of dollars just to find an just to find an adjoining piece of land, okay, where there's an oil well there, and then they start drilling. No, they have to understand the geological survey of that area by itself, so that they can actually plan more meticulously. Yeah, so the first thing is procurement of the geological survey data, so that they can start mapping the area, okay, and then follow through with where they think would best deliver the result. Then of course they need to finance through bank borrowings or issue new shares, okay, to have the capital to initiate the drill. So once you have the money, you need to secure the prospective block from the landowner or an authority's approval and permit to start drilling. Yeah, so you are interested in that piece of land, but you need to raise money first before you can buy that piece of land. Okay, and that land where you are interested in is based on the geological survey data. So once you have that piece of land, you need to secure the authority's approval and permit to start drilling. Okay, so once you secure the permit, the next thing is procurement or leasing of the oil rig, necessary equipment, and securing the manpower. Now, drilling for oil, you require certain expertise, yeah, and that's why you need to have the necessary manpower and qualified manpower to initiate the drill. So then you have the commencement of drill and the drill data interpretation. Okay, now if let's say at this stage there's no oil discovery, then that's it. You know, that amount that you spend to drill, has proven to be, devoid of any oil. Okay, and therefore the entire amount spent is burnt. Okay, but assuming there's oil discovery, then that is when the E&P company would actually commence the flow test to determine the commercial viability. Now, even if when they do the drilling, okay, and the extraction of that of the data shows that there's some layer of oil being present, it doesn't mean that that oil is immediately commercial viable, because it has to flow freely. Okay, and if let's say it's able to flow freely, then the cost of production would be much lower. But assuming that the oil structure, the oil is present, but then it's inside the rock, then you require fracking, which is more expensive. Okay, so that's why you need to determine the, when you have the flow test, you will know what is the next course of action. So if let's say the flow test doesn't yield the necessary result, then it's not commercially viable. Then again, that amount that you have spent will be burnt. Okay, but if let's say it's commercial viable, then the next stage would be perforation of the well and production commences. So once you have drilled a pipe down to the oil structure, okay, you need to perforate the well, and this is normally done by having minor explosive, yeah, that will explode and puncture the pipe, okay, to allow the oil to flow inside. So it's called perforation. Okay, so if let's say it is commercially viable, then you need to determine the oil reserve as well. Okay, because once you start production is one thing, but if you also need to determine the oil reserve, so that you know what is the lifespan of that well. Okay, because every year the production could deplete, okay, because of reduction in the pressure. Now, for those that are in red, then that will be written off as an impairment. So that's why for the E&P companies, it's often whatever they undertake, in exploration for oil-bearing strata, okay, is a very high-risk venture. So, but then stages in E&P can also cause certain volatility in the share price. Let's assume company A. Now, when they issue new shares to finance drilling, of course, new shares will actually cause dilution, then that would be negative. But if let's say they are able to secure financing to commence drilling, it could be positive. Okay, or they have formed a joint venture, and sometimes a company may own that piece of land. Okay, but then they are not going to drill it, but they are allowing a third party to drill it, and then they have a royalty. Now, this is called a farm in. Okay, they allow someone to come in and develop that the piece of land. Okay, so then there's commencement of drilling. Okay, once the company announced that they are going to commence drilling, okay, investors will be very excited, because they will be betting that the company will be able to discover oil, because currently there's a lot of expertise, and the chances of failing, although are there, but people want to partake on the risk because it is at this time that the share price would be on the lower end. Okay, so then oil discovery, that would be a major boost to the share price. But if no oil discovery, then the share price would come crumbling down. Okay, so after the oil discovery, when the share price have a boost, and then they announce that they will commence an oil flow test, then there'll be further boost, okay, to the share price, because you have oil, then commercial viable, then likelihood the share price would go up. Okay, so people will bet on the next stage. That's why E&P can be a very exciting to trade on the volatility sometimes. Okay, but if let's say it's non-commercially viable, then the share price would come falling down by heavy percentages. So again, that's the risk for investors in that sense. Okay, but once, if let's say in this stage, from commencement of drilling, oil discovery, commencement of oil flow test, commercially viable, and perforation and production, then you can see that the share price run up can be quite huge. Yeah, then of course further boost would be once they have determined that the oil reserve, and they announce that they have actually a very huge reserve on that piece of land. Okay, then that will be added boost to the E&P company. So sometimes if you want to look at the E&P companies, you may want to look at that volatility in that sense, the kind of activities that they do. So oil services it include upstream, midstream, and downstream activities. Upstream activities are geographical and geological survey, provision of rig and ancillary equipment, floating barges and submersibles, okay, provision of crew for rig operations, data analysis, provision of expertise in oil extraction, etc. Okay, so you can see that upstream activities, is bringing together large pool of talent from across the board. Okay, midstream services are more well defined, okay, in that it is piping, transportation of oil, whether it's through rail, ship, and truck, and storage. Yeah, downstream activities are refining, distribution, and retail of finished products. So what moves the share price of a service company? Positive for a services company would be when oil price increase, okay, because then they can command higher revenue or higher rental of equipment and so forth. They are securing a contract with a major oil producer. Okay, for example, Petronas have a tender and it's won by this particular company, then that would be a boost to this company share price. Okay, securing financing for capital investment. Okay, big ringgit. Okay, when it involves overseas activities. Yeah, so because foreign activities are normally quoted in US dollars. So if let's say the ringgit is weak, then the revenue in terms of ringgit would be higher. And then the high capacity utilization of equipment or facilities, okay, which means that the equipment are fully booked. Okay, it goes to show that the company is very vibrant with its activities. Okay, then that would be positive as well. But negative for a services company would be, of course, a decline in oil price, new share issues to finance capital investment, strong ringgit. Okay, again, this is a reversal of the weaker ringgit. Okay, because if you have a stronger ringgit, okay, which means those that you earn in US dollar but converted to ringgit will be lesser. And of course, low capacity utilization of equipment and facilities. Okay, when a particular company have a lot of equipment running idle, they cannot be rented out. Okay, then that would be that would cause the company's revenue to fall. So let's look at a case study, upstream E&P. In this case, we'll look at HIBISCUS Petroleum. It is an independent E&P company. Assets have combined 25.7 million barrels of oil in 2P reserves and 6.7 million barrels of oil in 2C resources. Okay, now 2P reserves are proven and probable reserves, which means it is as accurate as it can get. Okay, but if let's say you want to really determine that that the reserve is definitely there, then that is just the proven reserve. Okay, but normally people put it as 2P because probable reserve, that means a highly chance that the reserves are there and intact. Yeah, So 2C resources is contingent resources, which will become 2P reserves when the contingencies are removed. So this is something that they estimated, okay? Normally, when it is proven or probable, it's called reserves. But when it is not proven or it's not measured, okay, but they have certain theory behind the amount of oil, okay, then that is called resources. When it's measured, then it will be reserve or proven or probable. Yeah. So when they remove the contingencies, then the 2C would become 2P. Okay. It is important to note the reserves when evaluating an E&P company. So always look at the besides the revenue and so on, do look at the reserves. If let's say a particular company has dwindling amount of reserves, so they must really start to drill somewhere to actually expand their reserves. Otherwise, you have falling reserves, okay, means that the future revenue, okay, would likely to suffer, and that is very bad news for the company. So always look at reserves that is expanding, then that would mean the assets of the company would likely to be increasing as well. So this is Hibiscus Petroleum portfolio. You can see that they are active in the UK, Australia, Malaysia, okay, and in the UK in particular, in the Anasuria cluster, they have quite a lot of stakes, okay, in various fields, okay. Some of it is 50%, some of it is 19.3%, okay, and this is normally through joint venture. As I mentioned, sometimes drilling for oil can be very expensive, so that's why a company like to align themselves with like-minded companies that are interested in the same block or area, and then they work together towards fulfilling their ambition. Yeah, so that's why you see that sometimes this kind of venture is not 100% owned, okay, but in this case, okay, in Australia they have a 100% owned stake, okay, in here they have a 78% owned stake, okay. So in Malaysia, okay, they have a 50% stake, but then again this is subject to the completion of the contract. Yeah, so let's look at its first half 2017 financials. Year to date revenue growth of 219%. Okay, sorry, it's year to date. Year to date net profit growth of 276%. Current ratio of 0.67. Debt to equity ratio of 0.77. Share price of 70 cents. Net asset value per share is 51 cents. Share price over the net asset value per share is 1.4 times. So you can see that its current ratio definitely is a shortfall, okay, and likelihood because its debt to equity ratio is still far below the KPI that we set at 1.5, okay, then likelihood the company would have to raise funds through borrowing, okay, to ensure that its 12-month commitment, okay, is able to be met. Yeah. So Hibiscus Petroleum price chart versus the oil chart, you can see that once the oil price starts to trend up here, there's a bump in the share price. Okay, it has also moved up accordingly. Okay, so relationship between the share price and an E&P company and the oil price is something that you need to monitor. Okay, because it is essentially a producing. It is essentially an oil producer. Okay, so if let's say the price of oil spike higher, then it would be good for the company because across the board, okay, from the downstream, midstream, and upstream, there'll be changes in the pricing on the high side. Okay, so it is something that what we call a tide that will raise all boats. Yeah. So the other case study, upstream services. Let's look at SAPURA Energy, predominantly in offshore operations and in offshore E&P. Upstream services provider for the following: they have fabrication services, direct lay vessels, pipe lay vessels, subsea construction vessels, diving support vessels, accommodation boat and barges, float over this float over launch. Okay, float over launch barge, tug supply vessels, survey vessels, ROVs. ROVs are those remote control submersibles. Yeah, they have diving system, brownfield rejuvenation, turbine maintenance, well services, and rigs. So you can see that their entire portfolio of assets are very focused towards the offshore. Okay, so with oil price rising, how would SAPURA Energy fare? Okay, would we see the share price going higher or lower? Now you can see that it's first half 2017 financials here. Year to date, net profit growth, year to date revenue growth is minus 30%. Year to date profit growth minus 74%. Current ratio 1.15, but debt to equity ratio is higher than the KPI which we have set. Share price at $1.46. Net asset value per share is $2.12. Share price over net asset value per share is 0.69. Although it seems that it may be undervalued, okay, but then what is important to distinguish the company is that its net profit growth and revenue growth is really not there. Okay, they are actually falling, and this against the backdrop that the oil price would be unlikely to move back towards the high end of the 80s to 100 US dollar per barrel. This company would unlikely to see recovery in its revenue and net profit, because a lot of the big companies, okay, major oil companies have already deferred or cancelled their capex for offshore oil exploration, because SAPURA Energy is very focused on offshore, but with mounting debts, okay, of major oil companies, okay, and also because of the expensive nature for offshore oil exploration, we see that the net profit as well as the revenue being hit, okay, because there's no demand. In fact, one of the major players from Norway, Transocean, which is very focused in offshore drilling rigs, they actually have to sell their rigs at a loss, okay, just to ensure that they do not have a lot of idle rigs, yeah, which, you know, they need to constantly service the interest, okay, because they borrow money to expand their fleet of rigs, okay. So that's why with the unlikelihood of oil price going back to the high side, I doubt companies would want to look at extensive offshore oil exploration projects, yeah, because whatever is in the shallow waters, okay, you won't require so many that kind of expertise in terms of submersibles and so on. You don't require that much, okay, and also because of all the cancellation in the capex, okay, it will be very difficult for SAPURA Energy to realize, okay, high utilization of its assets. So that's why you can see that the share price, you know, ever since the oil price have fallen, okay, it has been trending down, okay, and you know, some of you might want to think that hey, you know, this could be a turnaround stock, okay, but you have to look at it versus the kind of potential for oil price, whether it can really move back up to the 80s or 100, okay, but without it moving much higher, I don't think the companies, the big companies would want to get bogged down by a lot of offshore oil exploration, which is, as we mentioned just now, can be very, very costly. So let's look at midstream services. Okay, DIALOG, predominantly in the midstream business in logistics services, storage tank terminals, and supply base. They have some upstream services. They are also specialists in products and services, EPCC, engineering, procurement, construction, and commissioning for upstream and midstream projects, fabrication for upstream projects, and plant maintenance. So, sorry for the typo, yeah, because this is copy throughout. Year-to-date revenue growth, 33.9%. Year-to-date net profit growth, 11.4%. Current ratio of 1.71, very healthy. Debt to equity ratio of 0.82, also a very healthy status. Share price of 2 ringgit and 43 cents. Net asset value per share is at 57.8 cents. Share price over the net asset value per share is 4.2. So valuation may seem very rich, okay, but then it has very strong fundamentals in terms of its ratios as well as revenue and profit growth. So let's look at its chart. Now, DIALOG is a very interesting chart, yeah, because you can see that when oil price fell, it did fall, okay, accordingly. But then as oil price continued to fall lower, okay, way into 2016, okay, 2016 oil was hovering around 20 over US dollar per barrel. But then DIALOG was not, has not fallen accordingly as well. It fell and then it started to move up, sort of stabilized. Then as oil price over here increase, okay, oil price increases, then share price take a lift. Okay, so what I can tell is that if you read about the storage containers and such that were happening during the 2015 to 2016 period, because of the price of oil was so low, but producers just have to keep on producing, because if they stop production, okay, there's nothing to pay for to service the interest of their debt, or to pay for the workers, or to pay for the depreciation of the equipment. So what happened is that they keep on producing, but then they anticipate that they want to keep the oil until the price of oil move up, so that they are able to sell at a higher price. Okay, so the oil producers cannot stop producing. So what happened is that they produce a lot, but meanwhile they also store a lot in anticipation that if further down the road there's an increase in oil price, then they can actually sell the oil. Okay, so what happened is that for a midstream company like DIALOG, they actually benefited because the demand for storage, okay, and that is why the DIALOG share price, okay, their revenue wasn't too badly affected, because there's demand for storage at that time. So when oil price finally take off, then of course bam, the stock really have a lift off, because it moves accordingly with the oil price. Okay, but then I think the share price is also well supported by other sectors in the company, because they are into plant maintenance and so on. Okay, and it's not so badly affected. Yeah. So let's look at another case study. This downstream services. This company is called HENGYUAN Refining, formerly known as Shell Refining. Refines up to 120,000 barrels of oil per day. Okay, refining facility is located in Port Dickson, second largest refinery in Malaysia. Year-to-date revenue growth of 42%. Year-to-date profit growth of 50.5%. current ratio at 2.52, very healthy. Debt to equity ratio is on the high side at 1.79. Share price of 10 ringgit and 76 cents. Net asset value per share of 4 ringgit and 41 cents. Share price over net asset value per share is at 2.44 times. Okay, again, you see that the company did very well as the oil price moved higher. So you can see that, you know, it has another lift off here, just as, you know, in 2017 the oil price started to move away from the $40 range into the $50 range. Okay, you can see that the price actually moved higher, but I think on top of that, there's also the increase in fuel price in the petrol stations. Okay, which then also further increase the price of refined oil. So let's look at renewable energy and the future of oil and gas. The shift to renewable energy could impact upon further demand for fossil fuels. Yeah, that's for sure, because renewable energy, okay, things like the wind, using wind as a source of energy. And right now, technology has advanced that people can use the rise and fall of the tide, okay, to generate energy. Okay, then there's also the solar energy. Okay, these are from the nature and it's free, and that is why you know, renewable energy now is gaining quite a huge momentum. Okay. Furthermore, with the risk of you know, what happened in Fukushima, also set the trend line that nuclear energy, although it can be clean up to the moment that, you know, the reactor fails. Okay, so that's why people are looking at other areas of energy. Of course, you have hydroelectric dam. Okay, those that use the water, okay, as a source of energy. Okay, then there are also a lot of development in biomass. Okay, biomass are those that are organic stuff taken from the sewers, okay, which they compress, dry, and then they burnt, okay, to create energy. Then there's also geothermal energy, which they use the heat from deep inside the earth, okay, to generate and to warm the house, okay, or to cool the house, because this is done through a compressor. Okay, then when you use geothermal energy, again, it is a free energy, okay, and it can be used without burning any fossil fuel, okay, to generate heat and to cool the house during summer. Okay, so there's so many types of renewable energy right now. Okay, and also the cost of renewable energy installations are getting cheaper due to improvement in technology and improved efficiency of equipment and photovoltaic cells in solar energy. Previously, the solar energy used the kind of photovoltaic cells that let's say deliver X amount of energy. Right now, it can deliver many times more the energy. Okay, because these are all improvement in technology. Then we have government's commitments to cut down carbon dioxide emission. Okay, will continue to drive the renewable energy sector. Okay, especially in Europe. Okay, there's a lot of guidelines being set that to cut down carbon dioxide and to eventually ban combustion engine vehicles, yeah, by I think around 2025 to 2030. Okay, but one of the things is that mounting debt of US shale oil producers, the bulk of which will become due in 2020, could mean more bankruptcies among US producers, and this could potentially support a higher oil price. Now, what is happening is that a lot of these US companies, shale oil producers, they are highly leveraged here, so much so that by 2020, the amount of debt that they need to pay, okay, back to the borrower, to the lender, okay, would go to the north of 200 billion US dollars. versus the current in 2018. I think the amount of debt due for repayment, I think, is about maybe 20 or 30 billion US dollars. So we can see that by 2020, 2 years from now, because we are almost at 2018 already, you know, the amount of debt that they need to pay back, you know, is almost more than 6 times the current more than 6 times they have to pay in 2018. So you can see that I anticipate a lot of them will be in trouble. Okay, some could be in bankruptcies, and if this the shale oil producers, which has always been overproducing, okay, that equilibrium is shifted, okay, then what we will have is that oil price could move up higher, okay, but unless the banks will continue to lend them money, okay, and then they continue where they are, okay, incurring further debt and so on, we do not know, but that is a potential threat of supply in 2020, and it could maybe give if let's say a lot of the companies are going to file for bankruptcies, then we could see support for higher oil price in 2020. But any surprise side on the higher oil price would actually be again gradually be diminished, because by 2025 to 2030, a lot of countries are going to ban the combustion engine vehicles. Yeah, so in support of electric vehicle or hybrid electric vehicles. So let's talk about the paradigm shift to electric vehicles. Many countries are imposing deadlines for complete ban of the combustion engine vehicles from 2025 to 2030. Almost 2/3 of oil is refined as transportation fuel. This could be a major setback for oil. Okay. However, transportation fuel for other means of transport such as trains, ships, aircraft, heavy vehicles will continue to be in demand until such time that electric batteries, okay, for heavy vehicles, okay, are made possible, okay, because heavy vehicles demand tremendous a lot of energy because they are used in moving earth, okay, in moving rocks and so on. So that's why the energy demand is quite high. So unless you know, technology have evolved such that, you know, electric batteries can really deliver that kind of energy, stored energy for these heavy vehicles. Otherwise, it will be back to fossil fuels. Yeah, but nevertheless, oil price may not see huge increase in price unless there's a major crisis occurring in an important producing nation. So, like I say, okay, any potential crisis that happens to top oil producers like Saudi Arabia, Nigeria, Kuwait, okay, the UAE, okay, Russia, that could actually cause oil price to spike, okay, if let's say there's any crisis happening in those regions. Yeah, so this is the end of our session. Let's move on to the Q&A.
Wow, excellent, PC. I think I've learned a great deal about the oil and gas industry with new terminology that you just shared with us today. I'm sure that most of our attendees will find it really useful and insightful, I believe. And if any question, you can post it up here and we will answer your questions. All right, I've already seen a lot of questions since earlier on. So yeah, let me look at the questions. So the first question is, will solar panel manufacturer company be a better investment compared to the oil manufacturing company?
I think you need to look at two different type of context. Yeah. Now, if let's say that solar energy company is just a producer of solar cells, okay, and it's being sold overseas, okay, then that may not be creating the kind of boost, unless if there's a tremendous demand of solar farming in Malaysia as well. Because in one of the biggest solar farms are actually found in elsewhere, where especially in China, where they are both producer and doing solar farming. Okay, China is the major producer of solar cells, one of the major producers of solar cells as well. But then they have tremendous farming in solar solar farm. Okay, they even build solar farms, floating solar farms. Okay, to harness the energy to supply to regions. So very importantly, if let's say a particular company, okay, is just producing solar cells for the export market, then it's very competitive because China is also selling solar cells as well. But if let's say unless there's a tremendous huge local demand in Malaysia, there's a lot of incentive given for people to convert into solar. Okay, then maybe that company could be a local supplier to the solar farms. Then that's a different story. Yeah, there must be consumption locally as well. But if you are just producing just for export, you are also competing with other big players. So that depends. Then you need to look at its revenue growth. Is it showing? Is that company increasing its revenue by double digits every year? Then if yes, then maybe it's worthwhile to look into it.
All right. So the next question is on what is your thought about the crude oil price until 2018? Are you bullish in the midterm?
I think you need to watch what is unfolding in the Middle East, yeah, and what is happening in the Korean Peninsula. These two places could be a tinderbox for things to come. Now, let me just share with you some news that I've read. Okay, for example, Israel, Saudi Arabia, and US, have been accusing Iran as being a state sponsor of terrorists. Okay, now this is what they did against Iraq before they invaded Iraq. Now they are playing the same playbook again against Iran. So does it mean that there's a potential coming against Iran? That's something that you need to watch with earnest on the development. Okay. Then again, in North Korea, right? Recently, North Korea has just announced that their latest missile tests have shown that it can reach Washington, D.C. Okay. So will the U.S. intensify the pressure, or will the U.S. decide to attack North Korea? We don't know. But you have to look at the kind of things that are developing. Now, one of the first things that you will know that a war is potentially coming to North Korea is when the U.S. issued a warning asking U.S. citizens to leave South Korea. If let's say that kind of warning is issued out, then there could be reason to believe that some military action might be coming soon. So you need to look for this kind of things that is going to, whether they are going to transpire or not. Although I did read another article that Jim Rickards, the author who wrote Currency Wars and a new case for gold, he did predict that the US may launch a military action against North Korea in the spring of 2018, which is roughly around the first quarter. So we do not know whether his is just an insider information because he deals with the CIA as well, or it's just something that is just smoke and mirrors. We do not know, but do look for certain indication. For example, if the rhetoric against Iran is intensifying, okay, then the possibility will actually run up higher, and because of that, people wouldn't wait for the war to happen to beat up the oil price. You can see that gradually that oil price would actually move higher. So you need to watch the kind of rhetoric. Yeah.
Okay, but North Korea doesn't have so much. It's not an oil producing country, isn't it?
Yeah, but what happened is that when
They will consume so much
US
oil.
military, yeah, but you look at it on the other side. North Korea is not an oil producing nation, okay? But if US wages war against North Korea, okay, what will happen is that we all know that the US doesn't have money. Every year they are printing money, okay? Their debt keep on escalating. So to finance the war, the US need to print even more money. So because printing more money will actually weaken the US dollar. And because when the US dollar is weak, oil price will actually move higher. Because any war would demand huge logistics for the supply of oil, okay? So we do not know whether if there's any potential war in North Korea, will it be surgical strike, which means get in, hit, and come out, okay? Or are they going to be bogged down in North Korea, which that means, it's going to be a long drawn affair, just as it was in Iraq, okay? So we do not know, okay? But then what will transpire is that because any military action will actually, especially spearheaded by the US, means US have to incur even higher debt because the US is pretty much broke. Yeah, their total debt to GDP is about 330%, and the total debt plus unfunded liabilities to GDP is close to 1000%. Okay, so it's literally broke. So if they want to wage war, they need to actually print more money.
Excellent. So we hope that war would not break out, and let alone nuclear war. So right, the next question is, could you explain the relationship between shale oil and our petroleum price, and what is the production cost of shale oil?
Production cost of shale oil actually is a bit of a myth also. If you read the newspaper sometimes or the mainstream media, they will say, hey, we can make money when oil is at this price because our cost is $25 per barrel. They will hype it out in this manner. Of course, the cost of bringing up that oil is $25. But then what happened to the kind of debt that you incur, the kind of equipment that you have purchased? Don't they incur interest payment and depreciation? So that's why they normally say that we can make money at $25 based on shale oil producers say. But if you go and check most of the shale oil companies, whether it's Pioneer Resources or Continental Resources, their cash flow is always negative, and a lot of these shale oil producers, 80% of their cash flow is used to finance the debt. So they also have a lot of smoke and mirrors. It's bullshitters, put it that way. Okay, that they can make money at $25 per. Yes, that's the cost of hiring the manpower, getting the necessary equipment and to bring up the oil. That's it. But the capital invested, the debt that they incur, okay, they never count that. Okay, the other type of oil that is very expensive is called tar sands. Now Canada have a lot of tar sands. Now the tar sands are actually very easy to extract because it's like a sandy oil pit. Okay, you just harvest it. But the cost of cleaning the tar sands into crude oil, okay, is actually $80 per barrel. So that's why any investment into tar sands is immediately a write-off case. Okay, now for Saudi Arabia, because their oil is actually from vertical wells, not horizontal wells, their cost is actually around $10 per barrel. Okay, but Saudi Arabia keeps on producing a lot of oil because theirs is a highly social kind of economy. Okay, socialist kind of economy, because they give a lot of benefits to their people, welfare and all those. So that's why they are running into budget deficit, and because of a low price, they need to expand their production even higher. Okay, but right now they are cutting back. Okay, gas is cheap, but because of the tremendous burden of the welfare society that the country is in, okay, that's why they run into heavy deficits.
I see. How do you spell tar sand? It's the first time I hear about it.
Tar as in TAR, and then SANDS.
Oh, all right. Let me share in the chat group if they all want to Google it up. So anyway, next question is, let me see. Just now you mentioned about for offshore exploration is about it costs about 200 mil to about 650 mil, right? Does it include the building of the rig platform and the equipments associated? So that's the question.
Yeah, it's everything all in, because when you start to invest in a block in a offshore, that include the cost of the investment in that particular block, because you need to pay authorities, okay, to access that block, okay. Then you start with most of the E&P companies wouldn't build their own oil rigs, rather they will actually rent it out. I mean, they will actually rent it from some of the provider like Transocean or Baker Hughes, those kind of companies, because they actually have a lot of oil rigs, so they actually rent from them, okay. Then other players like SAPURA Energy comes in, because when you do offshore, okay, that rig needs to be loaded onto the platform, okay. Then you need submersibles to actually anchor the rig and so forth, okay. Then you have people bringing in the drilling equipment, so it's a very large project involving many parties. Yeah, so that's unlikely that they would actually have their build one particular rate just for that. Normally it's rented from somewhere else.
Okay, so the next question is on, can you
Does that
explain?
answer the question?
Yeah, I guess so. So the next question is on, can you explain the difference between offshore and onshore? Because some of them may not
Offshore
understand.
means anything that is yeah, outside of the land surface, okay, which means it's either in the ocean, the sea, the gulf, or whatever is on water, okay. Onshore means land by itself. Yeah, it's everything is done on land.
Mm, okay. All right. So the next question is: if a state company have a very low inventories of 2C reserve, but 2P reserve are still substantial, so is there any cause of concern moving into the future?
I think most importantly is the 2P reserve. Okay, like I say, it's the resources is something that has not been proven yet. Okay, it needs to be proven before it moves into the higher rung of the proven and probable reserve. People normally, pay attention to the proven and probable reserve more than the 2C resources, because that has not been proven yet. Okay, so sometimes it could be lower than when they finally measure it, it could be lower than their original estimation, or it could be higher. So that's why people don't pay so much weightage on the 2C reserve, unless that 2C reserve is so big. Okay, let's say if the 2C reserve is just 2 million, 3 million barrels, or even 10 million barrels of oil, people may not pay attention. But assuming the 2C reserve is few billion barrels of oil, yes, then people will get very excited. So actually, you have to depend on the relativity of it.
Hmm. Okay. Um. So the next question is: do you think our companies listed here in Bursa have heavy reliance on Petronas contract? And what key parameters can we look at oil and gas company which shows efficiency in management? So this basically are two questions.
I think not all of them are relying on the Petronas tender and projects as well. For example, you can see that Dialog is already moving overseas, okay, and but unfortunately for SAPURA, they actually have a lot of projects last time in other parts of the world as well. So I think if you want to look for you want international exposure, then do look for those that actually have multi streams of income overseas, and overseas exposure, including their different type of multiple stream. That's why personally I think I like Dialog a lot, because theirs is something that is always recurring. Why? Because you have a storage tank there and it's always filled up with petrol. You know, it's an asset that keeps on recurring. Okay, unlike SAPURA's asset, you know, they have submersibles. But if let's say, you know, big oil companies don't have offshore projects, there it lies idle. You know, but forever there's always demand for storage, and that is why, you know, Dialog's storage tank would not be idle. Okay. Furthermore, they have various plant maintenance. You know, plant maintenance means recurring. Okay, and recurring streams of income. So that's why look for those kind of things that give you a broader exposure of revenue rather than just relying on a particular project.
Okay, so like what key parameters can we look at oil and gas company which shows efficiency in management?
I think one of the key issue is the cost management and also the debt management, because in the petroleum industry, oil and gas industry, there is always a very is a capital intensive industry. Okay, it's a very capital intensive industry, and therefore companies often incur debt. Okay, and you have to look at the way that the company manages its debt, because if let's say the debt has, you know, keep on accruing, okay, and with revenue which is not moving anywhere, then that could spell potential danger. I always look at how a company is efficiently run by relating to how a company manages its debt. Yeah.
I see. So do you think that the oil and gas industry will become a sunset industry in the future? That's the next question.
I don't think it will become a sunset industry, at least not for the next few decades, unless there's a breakthrough in the energy development. Okay, let's say currently we have electric vehicles and hybrid electric vehicles, and that kind of battery storage, yes, they can fulfill that need. Okay, like recently Tesla came out with a massive truck that can revolutionize the movement of goods, okay, from the fossil fuel truck. But then they never tell you that the kind of energy that is required, okay, that truck needs to consume electricity that is equivalent to 4,000 households. You know, so that energy efficiency is not there. So that's why for heavy haulage, heavy vehicles, even jet fuel, you know, I doubt, you know, because for airline, okay, there's, you know, it needs to be light, and jet fuel is light, versus you go and put, you know, multiples of chassis of lithium batteries or whatsoever, okay, to fly. Because as a plane fly, the fuel consumption actually lighten up the plane. But if you have the same battery stored in the plane, that weight is never reduced. Okay, so that's why I will still see there's need for fossil fuel. Okay, but what is likely to change is that unless the dynamics in the production side changes, for example, we look at coming 2020, how many of the shale oil companies will actually survive? If that part of the equilibrium is taken out, then yes, I think oil price will actually run higher. Okay, I think there could also be you know, changes in technology of using oil, you know, as a material for okay, not for fuel, but as a material for consumer use, okay, as a material for maybe building material use, I don't know. Okay, like currently, you know, a lot of plastic is all made from oil. Okay, the base material is still oil, and also fiberglass, resin, and all those. Okay, so unless there's a change in technology that have, you know, that oil combined with certain material, you know, can make that particular material tougher, okay, and good for, let's say, construction or whatsoever, then yeah, then oil will never die. You know, that there'll just be other types of uses. That's all.
Okay, so the next question is, the correlation of oil price affect the inflation rate. So is it better for the oil price to remain at low range? So in order for a better economic environment for majority of the countries?
Um, yes and no. Okay. Now, for example, if we look at Malaysia, Malaysia during the height of the oil price at 100 over US dollar per barrel, the economy in Malaysia was doing much better. Okay, but then we don't see heavy inflation during that time also, because the economy is doing well, and as long as inflation is manageable. But right now, what we have in the global economy is that there are inflation, but then there are also uh, but that inflation is not transmitted to gains in income or gains in salary and so on. But then, around the globe, people are seeing inflation in terms of housing. Okay, real estate has already is inflating. Okay, here and everywhere. Okay, around the world. Okay, healthcare is also inflating. Okay, but then that inflation is not passed on in terms of wages earned. It's happening around the world. So right now, what we see is that the global economy is very, uh, uncertain, because you have inflation in some areas, but you have deflation in other areas. So that's why it's becoming hard to predict what will happen next.
Mm. Okay, so the next question is, when you mention storage tank, do you mean the vessel type of FPSO?
No, storage tank will be as those that are, if you see sometimes the oil is housed in those round circular things that is on land. Those are the storage tanks.
On land?
Yeah, those round and circular objects that you normally see in those refineries and so on. Those are for storage of oil. It's not those those ships that carry oil. No.
Okay. So if newbies were to get started in investing or trading oil, what are some of your advice?
I'm not a commodity expert,
You are
but
not? I thought you are. Yeah,
I
you
only
share so
relate.
much about oil and gas with me, and gold and silver and so on. I thought you were an expert.
I look at movement in commodities to select shares. So, but I myself is not a commodity trader. Okay, so that's why I say I'm not an expert. But I look at price movement in commodities and relating it to the global economy to make my investment in share. But if you are going to trade in commodities, then one thing I always tell people is make sure you have stop losses because you don't know how deep it can go. But be very careful, and you need to, if you are trading oil, you need to understand what are the fundamentals behind it. Like the fundamentals behind oil right now, okay, is really not good. Okay, and that's why despite oil price now hovering around in the 50s, but the amount of short sellers in oil futures, is near record level. Okay, people don't believe in that the oil price can stay at this level forever. Okay, so you need to look at this kind of news and to judge where you should go. Yeah.
Okay. There's a question on this company HENGYUAN. And HENGYUAN, it was recently very hot, right? So the question is, why the company recovers so fast even though the oil price actually went down a little? Do you have some idea?
One of the key thing I think could be the our increase in petrol prices locally. Okay, because what is refined locally is sold through the networks as well. So I guess because it also have uh, uh, it's like a higher petrol price also would result in the higher refining charges maybe. Okay, so that's why it is also supported by the local increase in price. That's how I relate, because yeah, you are right, because the increase in oil price doesn't really reflect in that it should jump so high so fast, you see. But what we have between then and now is actually increase in petrol prices.
Okay. So is there any correlation between the crude palm oil to crude oil?
I beg pardon?
Is there any correlation between crude palm oil, CPO, and crude oil?
There's no clear correlation. Now, I always say that last time when we were doing about a sunset stock, a lot of crude palm oil, they try to sell the idea that they can replace they have biodiesel and all those. Okay, but you see that crude oil has actually moved up, but then crude palm oil has barely moved at all over the past 1 year. So in that sense, you can tell that crude palm oil is because a lot of people there's a lot of supply side is very huge. Okay, whereas crude oil is more volatile depending on who Russia wants to cut or Saudi Arabia wants to cut. But then in a crude palm oil, you cannot say that because I want the price to increase, I'm going to cut my trees. So it's a different correlation altogether. Although they try to like crude palm oil, some people say it's a substitute in terms of biodiesel. But then, like I say, the biodiesel is really quite a myth, because oil is already so cheap. Why do you want to convert crude palm oil into diesel, which doesn't justify that kind of cost? Okay, and furthermore, the consumption of diesel, okay, would likely diminish, okay, when a lot of the European nations go into combustion free kind of vehicles, okay, by 2025 and 2030. So in that sense, I don't see any great correlation, but there could be correlation in terms of the US dollar. Okay, for example, if US dollar suddenly becomes very weak, yes, crude palm oil may move up. But like I say, because the plantation side now there's so many plantations, that's not really affecting that kind of supply and the supply side. Yeah. For example, El Nino last time used to cause crude oil, palm oil to actually move up. But right now, the impact is hardly there. You see, because people are just having more land to plant palm oil.
Okay. Now, just now I mentioned that the offshore activity is cut now. So can we conclude that the prospect of oil and gas company with FPSO are not good?
I think for those in the offshore, those that involved in the offshore activities definitely are not too bright. But then you can see that there's a movement right now to look at rejuvenation of brownfields. Yeah, normally we have greenfield and brownfield. Greenfield means that it's something new. Brownfield is already been done. Okay, but smaller companies are moving into those brownfields to use their technology to actually withdraw the remaining oil that is abandoned by the bigger companies. So there's some rejuvenation projects that is ongoing, and these are the better prospect versus those in the offshore.
I see. All right. So, wow, thank you so much for your overwhelming questions. I still have like 10 over questions on my list, but of course the time is running out. So, thank you so much for participating in our webinar. And as you know, this is the last webinar for 2017. But of course, we are planning more webinars in 2018. Now, if you have benefited from the 2017 webinars organized by Bursa Malaysia, please also leave a comment on how we can improve, or what are things that you have learned, what are things that you have benefited, and is there any a testimonial you can give to us that would be better, that would give us some encouragement for us to organize next year webinars for you. So if anything you want to share with us, just in the comment box, just write to us on how this program has made a difference in your life. PC, can you turn to my last slide? Yeah, PC, can you change to my last slide? All right. So for
Yeah.
those of you who want to stay in touch with us or any question, you can send to PC at his email. And then last but not least, I want to thank all of you for participating in our webinar. And for those of you, I think I see many of the names who have followed through many series of webinar. I want to thank you for being our #1 fan for our Bursa webinar series. Thank you so much, and I wish that the knowledge that we share can definitely can make an impact and make a difference in your life. And I will see you at the pinnacle of your trading success. With that, thank you so much, and have a pleasant rest of the day.
Yeah. And good night, and thank you for
Yeah.
tuning in.
Thank you, PC, for dedicating your 1 whole year with us.
Okay, you're most welcome. Good night.